Hello, everyone. Welcome to this special presentation of the 18.6 Strategic Management Portfolio. My name is Catherine Stacey, and I work with Phil Anderson and Akhil Patel at Property Share Market Economics. Now, most of you here would have received your invitation to this presentation due to your connection with one or more of the services we offer at PSE. Now, we've not made this invitation public. And I just wanted to mention that to you. It's exclusive to our PSE followers. So very shortly, I'll be handing over to Mr. Tim Moffatt, Director of Oakley Financial, Dave Prescott of Lanyon Asset Management, and to Akhil and Phil. But there's a couple of things to note before I do. Now, due to the large interest that we've had for the presentation tonight, we've needed to change the video platform that we were going to use. So if you do have some questions, please jot them down and email them through. We'll gather up all of your questions and put together responses and send it out to you within the next week or so. So thank you for your understanding and your patience with that. So the presentation tonight will go for around 60 minutes. You'll hear from Tim and Dave first, and then Akhil and Phil will talk about the portfolio specifically in relation to the 18.6-year cycle. Now, the portfolio has been in the making for over 12 months now. And as mentioned earlier, Tim Moffatt is the Director of Oakley Financial, who holds their own Australian Financial Services licence. So for Phil and Akhil to be involved in this type of portfolio, it's important that they partner with a credible investment manager. So before I hand it over to Tim, here's a little bit about his professional experience. So starting off in Adelaide, he's actually been in the financial services industry since 2004. Now, I mentioned 2004 because when you see Tim, you'll notice that he looks rather young. Lucky fella. But he actually has over 17 years of experience in the financial services industry. In 2007, while studying for his Masters of Finance and Investment in Sydney, he worked for a number of different stockbroking and advisory services. And between 2011 and 2017, he was head of Private Wealth SA. That's a wealth management company in Adelaide. And in 2017, he started Oakley Financial with his own Australian Financial Services licence. So he's been creating and managing individual client portfolios for some time. He's now partnered with Phil and Akhil, and they have created this exclusive portfolio, which is available to you now. And it's based on an in-depth and precise understanding of the 18.6-year cycle. It is my pleasure to introduce you now to Tim Moffatt.
Thank you very much, Kathy, for that introduction. I can assure you there's a few grey hairs creeping in. The markets will do that too. I'm really excited about this presentation today. As Kathy said, it's been over 12 months in the making, and it's just from where we are now is the investment product, which is really centred around the real estate and banking cycle, tied with who we've got on the investment committee and with the platform that's on offer with one of Australia's largest financial institutions. I really think this investment portfolio has the makings of something pretty special. So I'm just going to get straight into it and get moving forward. Obviously, we've got the obligatory disclaimer. Most important thing here is anything we talk about today is general advice in nature. It's not personal financial advice, and we request you speak to your financial advisor before you do make any investment decisions. Just a bit of a quick overview of what we're going to touch base on today. Most of you listening in will have a pretty good base in the real estate and banking cycle, but we are going to just go through it briefly because it's relevant to how the money is going to be managed inside the portfolio. Second of all, we're going to talk about the portfolio characteristics, just the boundaries, I guess, and how the money is managed. We're going to talk through the investment committee. I'll introduce Dave Prescott, who you all most likely have not heard of. We'll talk about the current portfolio, recent changes that have been made, and then importantly, anticipated major future themes that we think the portfolio will hold going into the second half and the second half expansion. And finally, we'll just touch base on the platform itself, where the portfolio is held and the structure of how the portfolio is held on Macquarie Wrap. So why Oakley 18.6 strategic investment portfolio? Look, most of you are aware, but 18.6 years is the average duration of the real estate and banking cycle since 1800, when the US started selling off land. So never shorter than 17 years, never longer than 21, averaging 18.6. And importantly, we wanted that in the name because core to this investment portfolio is the real estate and banking sector, and we really want that to be central to how the money's managed. And we're going to pivot that portfolio around the cycle, and where we see in parts of the cycle where there's heightened risk, we will be taking more defensive stance. Where we see there's less risk and more growth, we'll be positioning the portfolio in that fashion. So again, a summary of the cycle itself, just to recap. Phil Anderson has really, I guess, added to this theory on top of Fred Harrison's work and people before them. But breaking the cycle into four stages. We've got the first expansion, roughly 5 to 7 years, followed by a mid-cycle slowdown, which importantly isn't land-induced nor affecting the banking sector in a material way. Second expansion, again, roughly 5 to 7 years. Historically, improved economic conditions. We start to see more asset speculation and leverage in the system, followed by a cyclical peak, bust, and importantly, this is linked with a fall in land prices, which puts acute pressure on the banking system and all the businesses that rely on it. You all would have seen this chart before, just summarising those different parts of the cycle with economic activity and, well, I guess, house prices themselves. How's the portfolio going to work in and around that? Well, the portfolio is going to have a fair bit of flexibility in its tactical asset allocation, and it will be specifically tailored in and around where we are in the 18-20 year cycle. At times, the portfolio will have a high share exposure, above 90%, if you can call it, or in reality, fully invested in shares. At other times, it'll have a high cash or other defensive asset class exposure. We are benchmarking ourselves against the MSCI World Index, which is effectively a global stock market barometer. It includes all the markets. It's heavily weighted to the US market, but it's market cap centric, so the US market is a large part of the global stock market. The competitive advantage of the strategy is leveraging our knowledge in the real estate cycle and its influence on asset markets through those different stages. And the investment community is really going to use that knowledge to make sure the portfolio has a real focus on capital preservation at those times of heightened risk and can maximise growth in those favourable times. So this is a bit of a graphical representation of how the portfolio's asset class tilts will behave. We expect in the first expansion we'll be overweight growth. Mid-cycle will be underweight growth moderately. Again, for the second half expansion, we expect we'll see high growth exposure. I would be expecting 90% plus shares and property. And then for the end of cycle, we'll be heavily underweight. So what that looks like, I suspect it means a high cash weighting and any way we can protect the portfolio. In terms of investable assets, Australian domestic equity exposure will be largely via direct shares. We may have some preferred ETFs in there as well. We're using some of those now in and around property exposure. International equity will be all via ETFs, and any other asset class, whether it's cash or bonds, will be via ETFs, and we have the flexibility to use listed managed funds, but at this point there aren't any in the portfolio. Portfolio characteristics, you can see here with the asset classes, we have a large amount of flexibility around asset class exposure. Effectively, we can go to 100% cash if we want to. At this point in time, that's not the case, but we can move money around asset classes with a lot of flexibility. So in reality, we can be 100% Australian, or 99% Australian shares and property if we would like. Again, benchmarking ourselves against the MSCI, investment management costs of 0.95, minimum investment is 50,000, and a suggested minimum investment time frame of 5 years. That isn't, you're not locked into the portfolio for 5 years, but that is a suggested minimum. We will hold between 15 and 30 securities at any point in time. There isn't a huge amount of concentration risk there because a number of our largest holdings are ETFs, which are heavily diversified in themselves. Just moving on to the investment committee, there's a couple of names there that you'll know, Phil and Akhil, myself as well, and Dave Prescott. What's really important here is we've got a fantastic mix in the investment committee. Phil and Akhil's role is really to provide a top-down asset allocation guidance, linking the portfolio and I guess the risks we see in different asset classes at those different times in the cycle. So their role is really to provide that top-down overlay. Also, not just how much exposure to growth assets or defensive assets do we want right now, but also with Akhil's work, what are the sectors of the market that perform better or worse at those different stages of the cycle? And Akhil's going to touch on that in a bit more detail when we talk about some of the thematics that we expect that we're leveraging ourselves to. Just with myself, I came across Phil's work a couple of years after the GFC, having looked pretty extensively and done a lot of reading around just trying to understand what happened and why. It's probably about 2011 or 12 that I came across Phil's work, and it was the first real, I guess, sensible explanation for what has happened, not just in 2008, but it had the data to back it up for not just one cycle or 20 years or 40 years, for a significant period of time. And look, at that point in time, I thought it was absolutely credible enough that I put it in I guess, my pocket of things to watch and manage, watch to use, I guess, as my arsenal around risks in the market. I didn't really rely on it too heavily at the time. I was pretty sceptical of anyone, I suppose, that thought they had a magic panacea to the way the world worked. But I guess from that point forward, 2011, 2012, every year things would unfold basically as expected, to the point where late last decade, late 2019, I was incorporating their work pretty heavily in how we were managing portfolios. And it really paid dividends come early 2020, where we were hot on the lookout for reasons for the market to come under pressure. And for obvious reasons, they occurred. And I guess the whole March madness of 2020 was a completely different experience for me, with clients having cash buffers and being able to use that cash at a difficult time. So very grateful for the knowledge, and very excited that we can use that now in this portfolio. So we're Dave Prescott. I'm going to introduce Dave now on screen, but I've known Dave for a while now. Dave's business, Lanyon Asset Management, have a number of funds that they manage as well. A little bit of a different investment philosophy and style, and Dave can talk about his business, but they're very much bottom-up analysts. Dave's track record, I think his flagship fund's done a bit over 13% compound since inception, which is a great return versus market. But what he probably doesn't talk about enough, I don't think, is they've managed to do that return while holding very high cash levels, I think around about 50% on average. So the actual returns of the stocks in their portfolio have been phenomenal. And the risk that their investors have had through that period is obviously been significantly diminished by the fact that their cash weightings have been so high. So I'm just going to hand over to Dave, talk a little bit about yourself and how you manage money. And before I do that, I actually might mention that we've got a relationship from a business point of view where we're leveraging off some of your research and services and your analyst team with our stock selection process.
Absolutely. Well, thanks, Tim, and thanks for having me. So to introduce Lanyon, so we are a specialist equities funds management business. I started the business in 2009, so we will turn 11 in a couple of months' time. We are, as Tim suggested and indicated, we are bottom-up fundamental stock pickers. So we spend our time trying to identify outstanding businesses that we can buy that are listed on share markets, both in Australia and globally, that we can buy when they're trading at a discount to our assessment of intrinsic value. So myself and the investment team that I work with, we spend our days researching listed companies, speaking with the management teams and the boards that are in charge of running and governing listed companies, and we do a lot of work valuing those companies. And what we are trying to identify is companies that are trading at a discount to the value that we have assessed through the research work that we've done. So we are very much fundamental, very much bottom up. We are what's called a value investment manager. So we adopt a value investment approach where we're trying to identify securities that are mispriced, and that's a philosophy that we haven't wavered from in over 11 years.
So where I think it's, and even today with the portfolio, where stocks that align with where we want to be right now, whether it's building materials or other parts of the economy, where stocks pop up that are in the Lanyon sphere that are also in the sphere that we're looking for exposure, is where I expect we're going to see performance, and it is already to date where we're seeing that. So it's just a really good blend in the investment committee and the team building the portfolio. The other two gentlemen on the investment committee don't need any introduction. You all know them very well, being PSE subscribers. Again, without going over it, they are there to provide the 18-20 year banking cycle overlay and help make sure that any exposure to the market that we do have is appropriate through the cycle. Just on the portfolio, current portfolio itself, and where we sit, or where we think we sit, somewhere in the transition from mid-cycle into the second half expansion. So we're probably, from an economic point of view, at the start of the second half, but I think we're all in agreement on the investment committee that perhaps the market's not quite there yet, and the portfolio is positioned accordingly. We made some recent changes, and I might hand over to Akhil now just to talk about the current portfolio and the changes that were made last week in the portfolio.
Brilliant. Thanks a lot, Tim. Thanks for the introduction and also for describing how we came to work together. Absolutely excited to be launching this portfolio and also to have a range of different perspectives on the investment committee. It's always important, I think, when you're investing in markets, not to succumb to groupthink, which, historically we see that people tend to increasingly do that over the course of each second half of the cycle. So I'm just going to briefly describe where the current portfolio is and to touch on some of the emerging themes that I think will drive outperformance over the second half of the cycle. So if we can go to the next slide, please. Currently the portfolio is, as Tim mentioned, relatively defensive. It's great that we have the flexibility to go into cash in a major way, and you'll see that we have recently made changes to reflect the fact that we see the markets at a relatively kind of frothy point. Those of you who have read our roadmap for this year know that we expect markets maybe to come off over the next quarter or indeed the second half of the year. And so our portfolio reflects that to a certain extent. Nonetheless, we also have exposure to things which are consistent with where we are in the transition between the end of the mid-cycle and the start of the second half of the cycle. So clearly property exposure both in Australia and we've picked a broad sort of fund of diversified property portfolios, as well as specific themes. So we've got Sydney Airport, which is around sort of the travel recovery theme. There's some exposure to storage, real estate, which is, I think, going to be quite a big theme as the second half gets underway and as we transition to the new post-COVID world. In addition to all of that, we have some defensive positions in relation to strong stocks, so Wesfarmers and Woolworths, and also stocks that have some defensive but protected qualities and moats around them. So Wesfarmers, as I mentioned, Elders and Unity Wireless. And then also, and I'll touch on this in a second, in relation to both the enormous stimulus and recovery plays that we see going on across markets globally. So exposure to Deterra royalties, for example. And then the other side of things, of course, it's now a global cycle. And so in addition to our Australian equity and property exposure, we are also invested in real estate globally. So and also high quality companies. So we have the Morningstar Wide Moat ETF, and then of course healthcare and technology exposures as well, very much consistent with where we are in relation both to the start of the second half of the cycle, but also the fact that, you know, we're emerging into this new world where healthcare and new tech is clearly a priority. Can we move to the next slide, please? So on the so this just kind of summarizes how we have made changes recently, and this gives you a bit of insight into, you know, how we think, and gives you a bit of flavor to some of the points that Tim made earlier. So in May, as we kind of approached a particular, what we thought might be a top in the market for at least a few months, we increased our cash exposures from about a third to just under half of the portfolio, and we reduced our Australian equity and property stocks from 43 to 38%, and similarly from international equity and property, we decreased from 26 to 16%. And I think the second bullet, second to last bullet on the blurb below is important. So we significantly lowered our US and specifically high growth exposure. So we have some exposure to it, particularly where you know, there are some defensive characteristics. But it was the option we thought, you know, markets have had a good run out of the lows last year, and we saw the signs of maybe a potential top coming up. So we were making the changes accordingly. And that's the sort of conversation that we have at our regular kind of monthly investment committee meetings. So now I'm going to touch on a couple of other sort of themes and then hand over to Phil. This current portfolio details there, you can look at them afterwards. So in terms of future themes, now, you know, there is an enormous number of different sort of insights that we can bring to bear on how second halves of each cycle play out. And so we've picked out a few of them, perhaps some of the larger ones. The first one is typically in the second half of the cycle, you find that with risk being on, US dollar falling, emerging market stocks tend to come into their own. They tend to have a slightly weaker first half cycle relative to developed markets, and then very much come into their own. If we can move to the next slide, I'll give you some of the sort of underlying analysis that we're looking at. So on a fundamentals basis, the emerging markets in the left of the two right columns, very much higher return on equity, lower leverage, higher historic recent growth, much lower price to earnings ratio. And that is, you know, characteristic of how the cycle plays out over the first half. If we move to the next slide, but during the second half of each cycle, in the red box, this illustrates what happened over the last second half of the cycle in sort of the mid to late 2000s. You found that emerging market stocks very much caught up, and so their price to earnings ratio outperformed the developed markets. Essentially, that basically means that we expect outperformance, and so we would look to take advantage of that movement as the second half gets underway. Next slide, please. Another theme is that typically in the first half of the cycle, you have outperformance in kind of real economy stocks, so technology, healthcare, manufacturing, whereas in the second half, you tend to get more outperformance from quote unquote more speculative plays, so commodities, property, and financials. And, you know, that would be something that we would seek to take advantage of. It's not that we wouldn't, you know, have some exposure to tech and manufacturing. Of course, these are going to be big themes for the next few years, but we would be looking in particular at commodities, you know, with the also the upside of the Kondratiev wave, the second half of the property cycle getting underway, and prices accelerating as we've seen historically in the second half of each and every cycle. In addition to that, and I think this is probably unique to this particular cycle, of course, we've all spent the last 12 months largely sitting at home, and, you know, businesses in some cases have a lot of recovering to do as we start to get back to new normal, whatever that looks like. And so we would take advantage of that recovery. This slide simply illustrates the fact that whereas towards the mid-cycle of the first half, you get very much concentration in large tech companies, as we did in 2000, and as of course we did in 2020. Over the second half of the cycle, movements are much broader based, and so we would make sure that the portfolio reflects that accordingly. Next slide, please. This illustrates that essentially the same kind of point, that the yellow line is healthcare and tech stocks, and the blue line is energies and financial stocks. In the red box shows what happened in the second half of last cycle, again essentially underscoring the point that is where you get advantage in a portfolio based upon our insight that we are now getting into the second half of the cycle. And then I suppose the final point for me is that we are, in addition to being in the second half of the real estate cycle, of course, in the upside of the Kondratiev wave, about which Phil and I have written a lot. And so we would be looking for a metals and mining play. Of course, that's already to a certain extent underway, largely boosted by low interest rates and huge amount of stimulus that governments are putting in place, with a specific focus on infrastructure, which of course will increase demand for raw materials. And we expect that to play out over a number of years. The US is about to pass a multi-trillion-dollar package, which is going to play out over at least most of the rest of the decade. And so we will be taking advantage of that. And of course, that's great for Australian stocks and indeed stocks on exchanges which are heavily resource dependent, such as the FTSE 100. And so we are, I think, going to be well positioned to take advantage of that. This shows outperformance of the global index versus miners in the first half of this cycle. And on the next slide, this is what happened in the second half of the last cycle. So the red line being the world index and the blue line being the metals and mining index, clear outperformance into the peak in 2007. And with that, I will hand over to Phil to talk about some other themes that we're looking at.
Thanks, Akhil. I will keep this brief. Future themes. Historically, I showed in my book, Secret Life of Real Estate and Banking, the fire sector, fire insurance and real estate, tends to outperform in the second half of the cycle. When detailing that with Australia, some of the other research also showed that the Australian stock market has usually broken into all-time new highs only in the second half of the cycle, and then banks and real estate being a large part of the index in Australia. And lo and behold, what have we got? You might have seen the headlines in the last month or so. Australian market breaking into all-time new highs, so it's looking good for our themes and what we've said will happen, because that's what has happened so far. Looking ahead to the future to take advantage of that, if we could just, we're looking at real estate and banking sectors. Just head to the next slide. Focus on the red line, if you can. This is the banking sector, 2010 to 2020, the first half of this cycle. The red line is the world index. You can see clearly the Australian financials, the underperformance in the first half of this cycle. If we go to the next slide, again, focus on the red line. That's the world index. Clearly, in the second half of the prior cycle, you can see clearly the outperformance of the financial sector. If we go to the next slide again, please. Here, focus on the purple line. That's the dividend yield on the market, allowing for franking credits. That tends to indicate, those statistics, that there is plenty of room for that thesis to be supported going forward. And then to the next slide. This is the REIT index, having a look at the first half of the cycle that has just gone. So we're looking 2010 to 2020, 21. Focus again on the red line being the world index. the REITs have underperformed in the first half of the cycle. If we take the next slide, again, focus on the red line. That's the World Index. The REITs in the second half of the prior cycle, you can see again the outperformance. Again, I've seen anecdotally, I've traced that back 200 years in the United States, particularly Australia follows the United States. So there's no reason at this stage why we should not expect that to continue, and that's what we are looking at. It all is well because the Australian market attempting to get into new highs now. So we will endeavour to be on board long term. The next slide, please. Again, future themes: clean energy. I suspect this is kind of obvious. We're not the only ones looking at that. Suffice to say, myself and Akhil, but the way we look at this is chart driven. So I'll be allowing the charts to tell the story on renewable stuff and fossil fuels. Significantly, though, we'll be taking care here because renewable energy and solar and everything else, there's no rent in renewables, so you can't own the sun. That will tend to reflect on the future, on the stock markets as such. So we'll be allowing the charts to tell the story with all of that, and just see how we go into the second half, which is about to get underway. The final thing I'd like to say, it's good that we've got the people connected here, Lanyon and others, because the last thing I want to do is get locked in a room where everybody agrees with me, because then you get groupthink. We'll be attempting to avoid that as such and allow the charts to tell the story. Thanks.
Thanks very much, Phil. Okay, so the portfolio itself is available now on Macquarie. I'll just talk a little bit about how the portfolio is run. It's via a separately managed accounts structure. It's a little bit different to what you may have seen in the past. A lot of people were using managed funds themselves. It basically combines the flexibility of having your own direct investment portfolio with the convenience of having your money managed like a managed fund. So you as an investor have direct ownership in the underlying securities inside the SMA, and you can see them. So you've got full transparency on that. So the assets aren't pulled together like in a managed fund or in another vehicle in a unit trust structure. They're literally sitting in your name or in your super account or pension account, but it is fully managed. So when we make changes at a portfolio level, they will automatically, those changes will reflect and be made inside your portfolio. So the assets are owned by you. Importantly, and I really want to drive this one home, you don't need a self-managed super fund. Macquarie's platforms themselves allow retail investors to invest. Effectively, you're opening an account just like you would be opening an industry super fund account. Macquarie itself gives you a lot more flexibility around what you own, and our portfolios are available for investment on Macquarie. So you can invest directly in your name or in a family trust, in a self-managed super fund, or in your superannuation or pension account themselves. Assets are held in a custodial structure and administered on the wrap service. So you are the beneficial owner, but they're just held on your behalf. Oakley Investment Management is an approved manager on Macquarie Investment Management Limited, and as changes are made inside the portfolios, they're reflected in your portfolio simultaneously. So the key benefits of an SMA, I think the key benefit for me is transparency. So you can actually see what you own, rather than just a one-line item saying you own XYZ managed fund. You actually see the underlying, you own 5% Wesfarmers or whatever else is in there. Another benefit is agility. We can make changes very quickly to take advantage of opportunities as they arise. Transaction costs are extremely low. It's $5.50 per transaction when we do make changes. Flat fee, so it doesn't matter how much FUM you're dealing with in your portfolio. Another benefit is tax. Your tax position isn't pooled. So I guess the example is if you invest today, an investor comes in today and buys Wesfarmers at $50, and another investor comes in and we still own Wesfarmers in a year's time and they're $60. Well, each individual investor has their tax position. The first investor's cost base is 50, the second investor's cost base is 60, and they're not affected by each other. Obviously, a benefit is convenience. We're managing the money for you. You don't need to be dealing with that, and all the administration's done. You can give an audited tax report to your accountant at the end of the year. For those that care, there's also the portability, so you can move your holdings out in the future if you deem you would like to. So the portfolio is available on Macquarie. Macquarie, look, everyone listening here, or certainly those in Australia, know who Macquarie is, one of the largest financial institutions in Australia. It's a real kudos to the team to be able to have these portfolios on Macquarie. Macquarie's really moved into the space of providing, the framework and services in and around investment management rather than being the advisors themselves. Effectively, they've stepped out of that space. But Macquarie's got two platforms. So rather than just pigeonholing for a typical type of investor, they've got two platforms that you can use. One's for, smaller and more simpler investors, very, very cost effective. That's Manager 2. And then Consolidator 2 is beneficial for large accounts, or if there's multiple accounts at a family level, effectively at fee caps per account, and it'll aggregate out the fees on a fund basis. So highly, highly cost effective, and you can select depending on your circumstances and requirements. Macquarie also, as an advisor, has very high technical capabilities. They're one of the few institutions that you pick up the phone and you can be speaking to someone inside of 30 seconds, which we certainly value from an advice perspective. And look, if you've got a Macquarie CMA, you've probably got the app that they've got. Like, it's all great technology. So finally, as a bit of a recap, what are we offering here? It's a professionally managed, transparent, cost-effective and fully administered investment portfolio, specifically tailored to be positioned to protect capital and leverage exposures through the long-term real estate and banking cycle. Currently, we're quite defensive. As Akhil explained, we've increased our defensive stance in the last, effectively, fortnight. We expect over the next 6 to 18 months that we'll really rotate heavily into growth assets, being shares and property, subject to how the market, the exact time frame on that will really just depend on how the market behaves in there. But we do see we see a strong 3 to 5 years ahead of us, and we fully expect to try and leverage that. So what are the next steps if you're interested? Look, the first thing to do is call your financial advisor that you currently have and talk to them and suggest to them this is what you want to do. If that's not an option for you, or you don't get any traction on that front, everyone will receive an email who is registered for this presentation will receive an email about now or very shortly, inviting them to register their interest to invest. You can obviously register also directly on the website. If you have no luck on those fronts, you can obviously send us an email at oakleyinvestor@oakleyim.com. If you're a wholesale or professional investor, you're welcome to contact me directly to discuss. One thing I will mention is there has been some interest from international investors. Macquarie itself has some limitations around needing a nexus to Australia, they call it, to open an account. So I just ask anyone who is interested in investing and they are overseas and don't have a nexus to Australia to please reach out, give us an indication of your interest, and that'll help us build a business case to replicate the portfolio in another jurisdiction. Just in regards to the registering interest to invest, we have a couple of advisors who are across the real estate and banking cycle that have put their hand up to help our investors get invested in the portfolio. So hopefully you can see up on the screen in a second. Just give a little wave, Tony and Jen. They're both very much across the cycle. They understand it, and they're more than happy to help anyone to get their money invested. So I'll most likely pass on your details to one of those two individuals. If you're an advisor and you have been following the cycle, please reach out. I'd like to talk more. I'd like to give a big thank you to Kathy. She's been fantastic in this process in terms of getting to the point of being able to have this portfolio available on Macquarie. there's not much else I can say. It's been great, and I'm really looking forward to getting on with managing the money with everyone listening.